This just escalated. I'm your host, Steve Van Metre, and thanks for joining me today. And every American is about to pay the price unless this changes fast, because the knock-on effects are even worse. Let's go to the Wall Street Journal, where we picked today's story up with the headline, Railroad Union Split Over Labor Contract. One of the country's largest railroad unions said Monday that its members voted to reject a new wage deal brokered by the White House, splitting with another large union and moving closer to a labor strike as soon as early December. And you can see that this has some serious ramifications from an inflation standpoint, because if the railroads strike, then we can always assume that there's going to be a transitory increase in prices at a time, as we've known and we've covered on the show, that Americans can't afford higher prices. So this becomes pretty serious, but it's what happens after, if this should happen, that makes things even worse. Let's continue on. Union leaders said on Monday they believe that a compromise could still be reached to avoid a work stoppage that could disrupt the flow of goods around the U.S. And this is really important because they need to do this. Again, we're talking about inflation here, and if the railroads strike, we're going to see prices jump. If you're following what's going on in the central part of this country, if you're following the trucking industry, you already have an idea of just how bad this can get. 4 out of the 12 unions have now rejected the proposed contract, while other 8 have ratified the deal, and both sides have agreed to a cooling off period until early December. And I have a hunch that by then, because there's some other things that are going to change between now and early December that could bring those unions who are not choosing to ratify quickly back to the table to sign. We'll get to that in a bit. Freight railroads moved about 40% of U.S. long-distance cargo and delivered freight such as feedstock, coal, lumber, construction material, and automotive parts. So you can see that a strike here will have broad-reaching impact on all Americans. Even a short strike could lead to diversions and cascade to delays and congestion, pushing back recovery in some supply chains. So when we talk about supply chains and we look at, say, the ISM or the S&P Global Purchasing Managers Indices, we see something called supplier delivery times. And if the railroads strike, those are about to get a whole lot longer and add to the inflation story. But normally when we see a slowdown in railroad traffic, it actually implies that things in the broad economy are slowing and inflation's coming down. But this time, it'll be entirely different. Let's take a look at these charts. Here we've got the consumer price index in blue on a year-over-year rate of change, and rail freight carloads in red, also on a year-over-year rate of change to the right. And notice that we have railroad cargo here, carloads is at 0, so there's no gain on a year-over-year basis, suggesting that this pulls the CPI down at some point. And we can note that usually when freight carloads are around 0, the CPI probably averages around 2.5%, which could just bring us right back to where the Fed's target is. So if we see a decline here, now normally that would suggest that the CPI is coming down even more, but I think in the short term, it means prices are actually going to pop before the strike is over and they come back down. We can also note the importance of the railroads. Here we see the consumer price index still in blue against the producer price index for line haul railroads in red. And you can notice there's a fairly strong correlation here. And normally we don't see that between producer prices and consumer prices because they measure different things. But of course we note that how are consumer products delivered to a lot of Americans? Well, by the railroads. So you can see here, if their raises are passed, which we assume that they will be at some point, that these prices are going to stay a bit sticky and could keep consumer prices up a little bit longer than we'd like, and that just keeps the Fed in target for further increases at a time the economy is slowing down. Congress, given its power under the Railway Labor Act, might intervene to impose a settlement on the two sides to prevent or shorten any work stoppage. The last one happened in 1991 and lasted about 24 hours before Congress and President Bush signed legislation ordering the workers back to their job. And President Biden is keenly watching this. As the president has said from the beginning, a shutdown is unacceptable because of the harm it would inflict on jobs, families, farms, businesses, and communities across the country. He notes that a majority of unions have voted to ratify this, and he's been keeping in touch on this. So you can kind of get a pulse here that if the railroads were to strike, there's little doubt in my mind that the president would step in and put an end to that, perhaps even with Congress fully backing him, because right now, if you see the railroad strike, you can only imagine that inflation is going to spike as well, and that goes against the policies that we're seeing out of the current administration to try to bring inflation down, especially as the Fed seems so aggressive. The unions have agreed to continue working under a status quo period to give time for more discussions. Although if one union ultimately goes on strike, leaders of the others have said their members won't cross the picket lines, putting us in a situation for an all-out strike. And if they do, now it gets even worse because there's problems right down the middle of this country. It's on the Mississippi, and I want you to see that if there is a rail strike, that this is going to have broad-reaching effects. It could lead to a large increase in unemployment and a large spike in prices, because the knock-on effect here, as you're about to see, is horrible. The Mississippi barge backup stalls millions of tons of cargo, as more than 2,000 barges are already halted by low water levels. As of Friday, the river was still closed near Stack Island and Memphis, Tennessee, a backup causing more than 2,000 barges at various points. Dredging activities are currently paused, and officials plan to reopen the waterway with restrictions when it's been determined safe to do so, putting a lot of pressure on the need for some rain here to fill up the river to allow these barges to go through. But wait till you see where this is going. The timing couldn't be worse because barges are busy carrying recently harvested corn and soybeans up and down the river, two of the three most heavily transported commodity products. Futures prices were a little changed for the week, but soybean cash basis, which better reflects how much farmers will get for their crops, sank to the lowest level since data going back to 2003. But here's how it ties back to the rails. If blockages are forcing companies to find other methods to move goods, such as metals, agricultural products, and fertilizer, while some are postponing planned loadings by barge until conditions improve, shippers are already seeing costs rise for rail and for truck transport. And of course, if the railroads are on strike, you can just see prices are going to shoot higher. But I'm not convinced that they're going to end up striking, because the bet, if you're planning to strike or you're thinking about moving in that direction, what you're hoping is for something to make your case stronger. In this case, what the railroads would need is a big surge in shipping on the rails to say that, hey, we're in demand and we deserve a better contract than the one that's presented to us. But what if more time passes and the evidence shows the demand is falling? And for that, we head over to a regional Fed survey. The 5th District survey of manufacturing here actually softened. We see some 5th District manufacturing firms reported softening conditions in November in the Richmond area. The composite manufacturing index remained negative, but edged up from -10 in October to -9 in November. You can see the trend here slowing, not a good sign for those railway workers hoping for an even better contract. Prices paid decreased, prices received increased somewhat. So what we know is prices paid and a factor of inflation is now decreasing. Prices received went up a little bit, but get this, expectations for prices paid over the next 12 months decreased slightly since last month, telling us that the future path of inflation is lower. Look at this, we see the future path of employment also trending down. We see wages trending down. And again, if you're looking to strike here, what you want to see is these data points of particularly the manufacturing sector, because a lot of goods are moved by rail. You want to see this surging higher to show that there's demand, and there's not. And it's not just the railways, it's not just the Mississippi, it's not just the manufacturing base where we see problem, we're actually seeing it globally. The global shipping industry is facing a new problem: too many containers. On top of falling freight prices, data shows container depots used to house containers after they are unloaded, keep in mind they're empty, are now filling up or full as there's nowhere to put these things. And what does it do? Is it points to more signs of falling global demand and impending economic slowdown, and that will affect the railways as well. And here you can see container ship freight rates tumbling and all the way almost back to where they were pre-pandemic. Traders and shippers say the decline in global consumer demand is not a sign the global economy is normalizing after a frantic post-lockdown consumption rush, but a downward shift in consumption appetites. So again, this timing of this railroad strike, which I think is not going to happen. I don't think President Biden's going to have to step in here. I think they're going to get into early December and realize the tide is turning, because the risk they're going to face is, yes, they're going to get a new contract one way or the other. But how much longer after that contract before demand says layoffs have to come? And I think that is what's going to happen. What's happened now is that cargo is on time again, hence again that supplier delivery time, and hence you'll see a slowdown in new ordering. And anytime there's a slowdown in new ordering, what that means is there is an increase in layoffs as companies adjust to a more efficient turnaround time in ocean freight delivery. And it's not just ocean freight that's signaling the economy slowing down. U.S. crude oil prices fall below 80 a barrel, and that is a sign of disinflation. At the same time, investors expect ongoing interest rate increases from the Federal Reserve, potentially sending the U.S. into a recession, despite data suggesting that inflation is beginning to weaken from 40-year highs. And on Friday, the price of U.S. crude delivered in December slipped below the price of a barrel delivered in January, a dynamic some commodities traders see as a warning signal of additional weakness ahead. Lower near-term prices encourage suppliers to store crude instead of selling it in hopes it will fetch more later. And such pileups tend to be sticky, suggesting a surplus that could weigh on prices in the future, particularly here if demand doesn't come back. And what we're seeing broadly now, you look at the manufacturing base, you look at global shipping, and you kind of turn that down into the railways, and you see that demand even there is slowing, of course, at the wrong time for their negotiations. But all this is pointing to is the global economy is cooling off and is doing it rapidly, which means the Fed may not get as many hikes in as they think. Here we can see the consumer price index against crude oil prices for West Texas Intermediate, both on a year-over-year rate of change. And we can note that as crude oil prices fall, so too does consumer prices. And likely there's a big tie here to railroads, because as demand for crude falls, well, guess how crude oil is moving across this country in a big way? That's right, through the railways. Despite the recent volatility, some Wall Street analysts still expect prices to rise next year for crude oil. And of course, at UBS said in a note that China's eventual reopening and expected production cuts from Russia will actually boost prices. The question is, will the economy slow down fast enough? So here's what I think. The railways are going to get their contract, not the one they want, but the one that's presented to them. And in a matter of months, the layoffs are going to hit as we see the economy slow down. We're seeing it across, again, the shipping, and we're seeing it in the oil industry, and that's only the warning signs of things that are about to get worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.